Hi everyone, my name is Augustin from Siam Legal. I'll be discussing specific tax questions for expats living in Thailand today. I'm continuing this series to provide answers to more detailed tax inquiries that will help you better understand the Thai tax system. Whether you're new to Thailand or have been here for many years, this information should prove valuable for your financial planning. If you're ready, let's kick things off. The first question of the day is, if I derive exempt assessable income, do I still need to file a tax return? If you derive assessable income that is exempt from tax, you don't need to file a tax return. However, you need to keep the proof of where the source of that income is in case the Revenue Department audits you. For instance, if you derive a Canadian pension, you're exempt from tax on that income in Thailand under the double taxation agreement between Canada and Thailand. Therefore, you don't need to file a tax return. However, you need to keep, for instance, the payment slips of the pension. Another question of the day is, if I transfer money from a foreign bank account that contains taxable and non-taxable income, how can I determine which part the amount comes from? Currently, there is no provision of law or ruling from the Revenue Department that governs the determination of income in a mixed fund. Therefore, it is the onus of the taxpayer to prove to the Revenue Department's satisfaction that the amount transferred is non-taxable income to avoid tax. If you fail to do so, it is possible that you will have to pay tax on the whole amount that you transferred. Accordingly, it is recommended that taxpayers separate bank accounts so that it is easy to identify what is taxable and what isn't, in case you are audited. For instance, you should separate between income earned before the 1st of January 2024 from that earned from that date, because the former isn't taxable, while the latter is possible to be taxed. Besides, you should separate accounts for each type of income because they are eligible for different deductions. This will be easy for computation of your tax liability. Another question of the day is, I inherited some property abroad. Will I be taxed on that income? To answer that question, it's essential to distinguish between personal income tax and inheritance tax. In the context of personal income tax, income from an inheritance is tax exempt. Therefore, you don't need to file an income tax return. On the other hand, in the context of inheritance tax, whether you will be taxed depends on whether you are a taxable person under the inheritance tax law. You inherit taxable property under the law, and the value of the inherited property exceeds the threshold set by the law. Another question of the day, how can the Revenue Department track what I have remitted to the country? In 2020, Thailand adopted the Common Reporting Standard, CRS, which is an international framework for automatic exchange of financial information between tax authorities of over 130 participating countries. With this system, the Thai Revenue Department gains access to a taxpayer's financial data, including details about bank accounts, pensions, credit card transactions, account balances, and financial activities. This allows them to track your financial activities, including the remittance of foreign income to the country. Another question of the day is, if I was gifted property situated abroad during the year in which I was a resident of Thailand, would I be taxed on that income if I bring it into Thailand? Well, that depends on your relationship to the donor and the total value of gifts during the tax year. If you are an ascendant, descendant, or spouse of the donor, you're exempt from tax of the total value of all gifts during the year if it doesn't exceed 20 million Thai baht. However, if the total value exceeds 20 million Thai baht, you will be taxed at a rate of 5% on the excess amount. If you aren't an ascendant, descendant, or spouse of the donor, however, you are only exempt from tax if the gifts are given in a ceremony or on an occasion in line with custom and tradition, and the total value of gifts doesn't exceed 10 million Thai baht. Examples of ceremonies or occasions in accordance with custom and traditions include birthday, wedding, and New Year celebrations. The last question of the day, does Thailand impose tax on capital gains? Thailand doesn't impose a specific capital gains tax. Instead, most gains are taxed as ordinary income, which means they are taxed under the personal income tax system if they are considered taxable. Examples of taxable gains include gains from the amalgamation, acquisition, or dissolution of a company or juridical partnership, gains from the alienation of shares in a company or holdings in a partnership, debentures, bonds, or bills or debt instruments issued by a company, a juridical partnership, or any other person, gains from the alienation of cryptocurrencies and token digitals, debentures, bonds, shares in a company, or shareholding in a partnership. Examples of non-taxable gains are gains from the alienation of movable property acquired from inheritance or acquired not in a profitable or commercial manner are tax exempt. For example, if you purchased a diamond necklace for personal use for 100,000 Thai baht and sold it for 200,000 Thai baht and making a gain of 100,000 baht, this gain is exempt from tax. All of these are answers to specific questions asked by expats living in Thailand. If you have questions regarding Thai taxation or would like to schedule an appointment with our tax consultants to determine your tax liabilities and how to legally minimize them, please check the information in the description box below. Don't forget to like this video and subscribe to stay updated on the latest legal insights in Thailand. Thanks for watching and see you in the next video.